Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Scarlet Fu. We're counting you down to the closing bell. We're here to help take us beyond the bell. It's a global simulcast, joined right now by Massar and Matt Miller. Welcome to our audiences across all of our Bloomberg properties, television, radio originals, and for those folks streaming us on YouTube. Massar.
What?
A pretty big rally, particularly when it comes to the NASDAQ indices, which are now up about 2% on the day, the NASDAQ 100, I should say. This is a pretty strong rally, but Scarlett and I have been debating really how sustainable this is. Is this just kind of a one-day thing, and then everyone just kind of goes back to the dour sentiment that we've had?
I think you're onto something. I mean, just look at, the expectations about Fed's going to cut rates, Fed's going to raise rates. Like, it's all over the place. What I will say, though, on this uptick, certainly on the equity side of things, there's some conviction behind it, and we see some volume behind it as well.
I also think when you see people selling defensive sectors, that leads me to believe that there's conviction in a rally, even if it's not as quite as strong as it could be. Although, 1%, last time I looked on TV, we're only up about 0.5%. So it's getting better and better into the close. And it does make sense to me that investors are no longer worried about the debt ceiling. We're probably going to continue to play it up in this program.
Is there something else?
We do. It's not done yet. We could still default. I know, right? But come on, we can move on at this point.
Well, the markets would like to think so. Maybe that's what they're counting on. But as we know, it ain't over until someone agrees to it.
Exactly.
And there's still a ways to go.
Exactly.
Yeah, we talk about some of those sectors, obviously tech out in front here, as well as some of the discretionary names. And as Matt was just alluding to, the defensive sectors, healthcare, utilities, staples, real estate on the back foot. But nevertheless, given some of the market action and really the tight trading range we've had over the past few weeks, I think a lot of investors will take it. The Dow Jones Industrial Average higher by more than 100 points on the day. That's going to be good enough for about 0.3% gain on the day, and that is your relative laggard. The S&P 500 looks like it's going to close at its highest level since August of 2022, higher by 39 points or about 0.9% on the day. The NASDAQ 100 and the NASDAQ Composite both higher by 1%. The Composite up by 1.5%, and we should point out the NASDAQ 100, which has been the perennial outperformer all year long, now at its highest level since April of 2022, a fresh 52-week high. The Russell 2000 participating as well in the rally. Carol, up 0.6%.
Yeah, and listen, also helping the rally is the semiconductor area. You've got the stocks up about 3.2% here. Micron above them, up about 4% here. You had Micron getting that $1.5 billion investment from Japan. So there's a lot going on in that sector. Really some outperformance, Matt.
Yeah, take a look at the sector breakdown, actually, and this goes to the point I was making about investors selling defensive stocks. The losers, in fact, now the only losing groups on the S&P 500 are real estate, consumer staples, utilities, and healthcare, so all very much defensive. The winners are those IT stocks, and then communication services, which once again is a pretty poor name, I think, for this group, but it includes like Take-Two Interactive, which soared yesterday after missing on every single line in its earnings, and Netflix, which is up, 10% at the close.
I wanted to get you a couple of earnings here crossing the wire right now. Applied Materials just coming out here. Their fiscal second quarter numbers. Adjusted EPS looks like a beat coming in at $2 a share. The street was looking on average for $1.83. As far as net sales, they're coming in at about $6.63 billion. That's a little bit higher than the average street estimate, which was for $6.4 billion. Also, they're giving a breakout of its semiconductor systems net sales coming in about a $5.98 billion. We'll round it up to 5. The street, Scarlett, was looking for about 4.85.
Yeah, and the stock bouncing around here in the after-hours trade, the display and adjacent markets part of its business, which is the smallest part, actually saw a drop of 56% year over year in terms of net sales. So that's a little bit of a wrinkle in its earnings, but right now it is higher by 1%.
All right, so that's up about 1% here. We'll continue to watch AMAT. Let's get to Ross Stores because they're also crossing with their earnings. First quarter EPS, folks, that is 3 cents better than what the street was expecting. $1.09, $1.09 a share versus the estimate of $1.06. First quarter comp sales, always important for the retailers, up 1%. The estimate was a gain of 0.7%, so some outperformance there. And let's get to the outlook. Ross Stores seeing second quarter EPS of $1.07 to $1.14. That's light, folks. The estimate is $1.25 a share. And fiscal year EPS, Matt, they're looking for $4.77 to $4.99. They had seen $4.65 to $4.95, so a bit of a range still there, and the street was looking for $4.93. Ross Stores, if we can pull it up for everybody, a quick check on the aftermarket, and the stock is up 1.25%, Matt.
I'll tell you what, the Ross Stores forecast reminds me a little bit of what we saw out of Walmart, right? Because they raised their range, and it's in terms of Ross Stores, it's considerably above where they'd seen it before, but they just basically playing catch up with what the street already saw.
All right, well, I want to pivot from this real quickly back to the debt ceiling debate, and of course, this daily look at the Treasury's cash position. That Treasury cash position now dropping to about $68 billion roughly here. Of course, that's one of the lowest levels that we've seen in quite some time, at least since 2021. And we heard from Janet Yellen a little bit earlier, who had met with executives from some of the biggest corporations, really trying to drive home this idea that a debt ceiling deal has to get done, and it has to get done soon.
I don't remember if they did this in 2011 or in previous debt ceiling standoffs where they would give the Treasury's cash balance every single day. Did they do that?
It is released every day, but like a lot of things in 2023, we didn't pay attention to them back then, like SLUs, and I'm probably forgetting a bunch of other, all these reports that we pour over as if they are.
Now it's a high-frequency data point, right?
Yeah, but but it matters, and I mean we kind of joke about it, but the idea here that they've been doing everything in that sort of emergency toolkit to continue to sort of keep things functioning. And $68 billion for an economy, for a $3 trillion economy, is nothing. It's minuscule.
Well, and I guess what I would say is that, certainly investors care about this, right? We've seen it certainly play out in the equity and the Treasury trade here. So getting something like this helps them give a little bit more information in terms of what the environment is and the importance of what's going on in D.C., Matt.
I don't know if you all read Liz McCormick's story today, but she has a chart in there where you can see the debt ceiling and the debt. And if you look over the last 5 years, we spent a lot of time on the wrong side of that ceiling, so Congress could just as easily suspend the debt ceiling while they negotiate. The interesting thing to me is on the other side of this, how much Treasury issuance we're going to see, especially at the shorter end, because the warnings are that it could be $750 billion to $1 trillion of Treasury issuance to get that cash balance back up, and that could soak up all the liquidity at a time when we need it most.
Well, I'm glad you brought that up. We were speaking with Ira Jersey, of course, Bloomberg Intelligence chief interest rate strategist, and he's raising the alarm on this as well. I mean, there's already so many distortions right now in the Treasury space here, and if that liquidity is pulled out of the system, which it will be, I mean, just that's by its very nature, the question is how much sort of pain does that cause in the interim until we get back to whatever that baseline level that the Treasury
I think there was a firm that said that it all comes back to, it'll be the equivalent of a 25 basis point rate hike, that drained liquidity. So can you blame all the companies out there that have investment grade ratings going out there to sell bonds, raising cash while they can, taking advantage of the calm that exists right now?
Well, and this is just another thing that kind of complicates what the Fed has to do, right? There's different market dynamics certainly happening and maybe helping them in their mission to kind of slow things down and take out some of the cash in the economy.
But this goes back to my initial question, Carol, about the idea of the sustainability of the rally. It's easy to sort of get excited about the debt ceiling resolution, but you kind of forget there are all these other problems that we have in this country that we still have to deal with once we get this debt deal done.
We don't forget on this show. Carol reminds us quite often about all the problems that we face.
No, but I do think about it, right? I mean, the debt is still going to be out there, and we've got to think about that longer term. But I do wonder about the economic growth going forward. We keep pushing out recession.
Yeah.
I mean, do we just kind of write it off at some point? I don't know.
Look at Anna Wong's forecast.
I know.
Oh my goodness, is it bearish?
Well, what is it right now?
4.8% unemployment in the middle of next year, and possibly as much as 5.3%.
Those weekly jobless today don't show that.
Yeah, I mean, well, they do good research, but they've been on the bearish side for a good portion of the last 12 months or so. I am curious, though, did you listen to some of the commentary we got out of the Fed members today, particularly with Philip Jefferson and Lori Logan? Obviously, everyone making a big deal about the Fed skip, if you will, instead of a Fed pause. But they all seem to make clear here that they don't see the fight against inflation over, which my reading of that is don't expect any rate cuts anytime soon.
And in fact, people are now pricing in a rate hike in June as well. I believe 40% odds that the Fed will resume hiking in June.
Or that could change.
The 37%. I mean, it's got to get to like 85 or 90 before it really turns into a hike. But yes, it's starting to get priced in again. And I'm always surprised to see how many rate cuts are priced in this year because Jay Powell has.
Do you think Jay Powell just punches warp on the Bloomberg terminal and says, "Oh, it's only 40%. We can't hike"?
No, I don't think he does. And they could
that would be
hike,
great, right?
But
That'd be a great sales.
It's much more unlikely that they cut.
Jay Powell doing a little commercial for the Bloomberg. No, I think bottom line, guys.
I'm going to say he does that.
Okay, but bottom line, they're data dependent, right? So this is why we see the wackiness, which is why it goes to where you said at the beginning, Romaine, whether or not we see this rally hold. I think it just depends on the data points. All right, we got to go. We're being told we have to leave. All right, that's a wrap. Our cross-platform coverage, radio, TV, YouTube, and Bloomberg Originals. We call it Beyond the Bell. We will see you again, the whole gang, 4 p.m. Wall Street time tomorrow.